Hello everyone, welcome back. Patrick here. Well, I don't think I need to tell you guys that the market has been very difficult this past week. Your portfolio probably feels it right now. But I ran this poll on Friday around noon, right? Asking people, how are you holding up with all of these big SPAC crashes? And it seems like most people seem to be doing okay, struggling, but getting through it, right? And as the day actually progressed, I mean, in the morning, I had a lot of pain. First of all, I was at the chiropractor. That doesn't help, but also the market was really bad in the morning. My portfolio was down by a lot. But then by the end of the day, we were actually green. So now we have to ask ourselves, I mean, is the crash over already, right? Is it time to get back into all-in buy mode? So that's what we'll talk about today. I'm going to show you like what I think is going to happen and where we're at right now. I'm not sure if it's time to like go fully all in yet, so we'll talk about that. I hope you guys enjoy the video. Please like and subscribe. It really helps out. Alright friends, you're probably going to think that you're on CNBC because they love talking about this stuff, but it really is important. If we want to understand what's going on and how to plan our moves for the next week or two, we need to understand this. And that is the potential hike in interest rates over the next year. Remember, the market is always forward-looking, not backwards-looking. So whatever happened last year doesn't really matter anymore. Now we're looking at what's going to happen in the next 12 months. And this is why the Treasury note for 10-year is very important, because when people actually sell their bonds, it makes the yield go up. And that's why people are really worried about it right now. Because even though if you look at it, this goes back to like 2006. Right, so historically, the rates are still very low for the yield on the 10-year Treasury note at 1.56%. But when you zoom into it is where people are a lot more worried, because if you look at the 1 month, last month in February, the low was at 1.13%, and now we're at 1.56. So that's an increase of 43 basis points in just 1 month. Well, where are we going to be in 6 months, in 12 months, right? Especially when you zoom into it even more, look at the past couple of days. Well, that is really putting a lot of selling pressure in all the growth stocks. I've talked about it a little bit in the previous video, right? So look at how there was a massive increase between Thursday and Friday when they announced the job report. Because I don't know if you guys actually follow this fairly close or not, but they announced 379,000 new jobs in February, which is much higher than the 210,000 that was expected. Well, what happens when there's more people working? What happens when people are going to like get the vaccine and there's a lot of pent-up demand? That's going to cause a lot of people spending, right? And that is inflation. Right now, the oil price is going up very rapidly. So there's a lot of factors going on right now that really cause a lot of concern. So right now, they just announced the 1.9 trillion in COVID relief bill was passed, right? Both in the House and the Senate. Well, that is going to cause even more potential increase in the economy. Everyone's going to get that $1,400 check, and what are they going to do with it? Well, we saw last year that people have been spending it, and that's why the price of assets has gone up so quickly. So you would think like, well, the economy is going to do so well, right? The companies are going to report incredible numbers over the next 2 years. So that should be great for the stock market. In theory, it sounds like it would, but it's going to be great for certain companies, and then others are not going to benefit from this. The thing is that the more inflation there is, the more it's possible that the government and the Fed is going to increase the interest rates. And when the interest rates increase, well, now you have to make a choice between like putting your money in a savings account and getting like worst case scenario back in the day, when people were getting 8% or 10%, or putting it in the stock market in companies that often are going to get 10-20%. Well, most people in that case, like that super extreme case, are going to put it in a savings account. Right? So that's why the inflation numbers are extremely important. And this is what like Jay Powell keeps saying, that they'll just monitor it. And just by saying, like, just hinting that they're going to monitor it and then at some point they might have to look at it is enough to cause a lot of panic in the market. Let me tell you what we're going to do next week. We are going to look at the price of oil. Now you're going to say, why oil? How does that teach us anything about SPACs? Well, everything is interconnected. And I know that it sounds weird, and I hope that you guys don't mind me showing you all of these graphs. If you do, let me know in the comments. I'll try to figure out other ways to explain this. But I want us to look at oil next week. It is going to be our key indicator. You know why? I'm going to explain it. So right now, the crude WTI oil is at 66.28, right? So if we look at the past couple of months, look at how there's a steady growth on the price. And this is very, very important because last year, when the economy shut down, well, there was a lot less demand for oil. So the supply was cut. You guys know that all of the oil producers were really struggling last year. Now the demand is increasing, but the supply isn't all online yet. So the price of oil is going up because there's more demand and less supply. So that in itself, like, sounds normal, nothing wrong, aside from when you go put gas in your car, it kind of is frustrating, but you know, you can't really see anything wrong with this. But when you look at the 5-year chart is when you are going to understand exactly what people are worried about. This is a simple moving average over the past 5 years. It's been going down slightly, but over time, if you look at the blue line, you guys can see that it's been mostly around between $40 and $60, but closer to like $50 range, right? So that's been the price of the WTI. But what's happened since last year? Look at how it dropped massively under the average. And what's happened over the past couple of months? It crossed the average, and now it's above it. And now it is at $66, higher than net 50. And where's it going to go in the next month? This is why we need to track this, because this is going to be our inflation indicator. If this keeps going up, people in the government, people at the Fed, all of those guys and the hedge funds, everyone is going to be looking at indicators like these to decide if we are going towards an economy that's going to be inflating, right? And they're going to have to increase the interest rates. Or if you see a curve like that, a reversal, and it stabilizes and stops going up, they're going to be like, all right, it's not going to be too bad. Like, the economy is going to correct itself. We're not probably going to have that inflation. So that's going to give much more leeway for Powell not to increase the rates anytime soon. Yes, I know that they don't plan on increasing the rates for a couple of years, right? But if the inflation really goes crazy, then they wouldn't have a choice to do so. So often we're kind of myopic and we really pay attention to the SPACs, and we're feeling like SPACs have been getting absolutely wrecked over the past month or two. But if you look at the rest of the economy, there are some parts of the economy and the stock market, I mean, that are doing extremely well. Again, look at Chevron. I mean, this is not a growth stock, right? But it has gone from, $84 to $108 over the past month and a couple days. This is, Exxon. Look at how it's been trending up. I mean, it's behaving like a growth stock. This is what you guys were probably expecting from our SPACs over the past couple of months. And this XLE is the actual index that tracks it. You guys can clearly see it's been going straight up over the past month or two. So even though our SPACs are getting crushed, everything that is more industrial, more value has been increasing. So one of my best positions, which I'm going to keep mostly for another video, but has been MGM, which is one of the most recovery play oriented stock that you can get. And look how since the beginning of the year, I mean, it has gone from like the high 20s to low 30s. And it's gone up to $39 at some point, almost 40. So yes, over the past couple of days, it has been hurt like everything else. We've seen that almost everything in the stock market has been sold over the past couple of days. But look how over the past month, instead of being in a massive downtrend like some of the SPACs, it has been going in an uptrend. So that's why you can't really just look at the SPACs. You need to look at the entire market. There's always different opportunities out there. Alright guys, in the wrap up, because I want to keep this video short, remember, I'm not your financial advisor, so this is just my opinion. This is not financial advice, but in the end, we have to ask ourselves, is it time to load up on these SPACs? Is Friday's rebound going to continue into next week? Should we like really go all in, or should we be a little bit more cautious and is there more pain coming our way? So as usual, you guys know that there's no one answer fit all. It doesn't matter if it's on YouTube or on TV. No one actually has a crystal ball to say whether last week was the bottom or if there's going to be more pain coming. But what we can do is analyze it based on the different stocks, right? So if we look at SNPR, this is a company that I like, and I know a lot of you guys like, And right now it's at 11.28. So the risk versus reward for this company has changed drastically between last week and today. So buying into it at 128, you have about $1.28 that's at risk, because there's about $10 or a little over $10 in their trust account that you can actually redeem your shares for if for some reason the market really tanks and the share price went under $10. So that gives you a lot of protection. So for a company like this, if I want to open a position at 11.28, that's no big deal. If it drops to like 10.50, then it's going to be a lot easier to average cost down than when it was at $17.50 or $18, where you're at $8 at risk. And then, it keeps dropping and dropping, and you're buying the dip, Well, at some point, you run out of money buying the dip. But now at 11.28, you know where the floor is. So that gives you a lot more stability, and it's a lot easier to actually buy now for this company. But when it comes to the warrants, though, remember that there's no floor price for the warrants. So if the market really tanks, you don't have that floor, right? So the warrants right now are fairly cheap at $2.55, right? They've almost never been cheaper than this for this company. So you can say, well, that might be a great price. But again, remember, warrants in theory could go to 1 cent. We know it's not going to happen, but you don't have that same protection that you have with the shares. So, if I wanted to really load up on warrants for this company, I would wait and see what happens next week personally. Then you have other companies like TPGY, which even though we like the company, right now it's at $18. So there's more at risk buying shares of this company than you would at SNPR. So I hope you guys understand, like, risk versus reward is going to be different in a downtrending market at 11.28 versus 18.07. Same for NGA, $16, right? We've seen that it went so low. Wow, 12.88. I mean, that is absolutely ridiculous for NGA, right? But it can keep dropping. So that's why for shares that are above $14, $15, personally, I'm going to be very careful. I'm going to wait and see what happens next week. I need more than one afternoon to get confirmation that the stocks are going to stabilize, right? So if it goes up Monday, if it goes up Tuesday, then I'm going to feel a lot more comfortable buying more shares after I bought on Thursday. And then, again, the warrants, 508, there's a lot of room for them to go down. They went down to $4 almost instantly on Friday. So again, this is the type of position where I would be a little bit more cautious and really adding a lot to my position. So guys, I hope you enjoy the video. Let me know in the comments if you're already going to be buying and loading up, or if you're going to be a little bit more patient. Want to know what you guys are going to do. So I'll see you guys next video.